So this chapter is quite technical. I tell you now, okay? It covers the concept of risk and risk premium, and the concept of portfolio, also efficient portfolio, what we mean by efficient portfolios, okay? How do you assemble efficient portfolio? We're talking about investment portfolios, okay? And then how to reduce the risk in your portfolio by combining different investment subjects, investment items, okay? And finally, in this chapter, you're going to be introduced to the concept of beta and CAPM. CAPM, capital asset pricing model, okay? And probably you heard about this. This is a pretty popular model in investment theory, okay? So you have a lot to expect in this chapter, okay? And I can start this chapter by reminding you of the first principle of the finance, in the topic of finance, I told you, okay? There is a positive correlation between what? There's a positive correlation between risk and return. You see right there, right? Risk and return. Right? Why is it? Because whatever investment which involves a higher risk, investors typically require higher return, right? If you're going to put up your money for some investment that's risky, right, then you might as well require or expect higher return, right, to get compensated for the risk taking, okay? All right, so that's the idea of risk and return, right? So how do we calculate the return? Last class I showed you how to calculate monthly return through Excel spreadsheet. Okay, I'm pretty sure you understand that concept. The new number minus old number divided by old number times 100. Okay, or today's closing price minus yesterday's closing price divided by yesterday's closing price times 100. That will be daily return. Okay, daily return. The only thing is for closing price, I suggest you to use adjusted closing prices instead of just plain vanilla closing prices, right? Because all those adjusted closing prices are adjusted for any cash dividends and splits and so on, okay? So that those are more accurate reflection of what happened to the stock price, okay? All right? All right. So expected value and standard deviation of return, or expected return, we use R hat. We read this notation as R hat, right? And how do we calculate the expected return? That's simply a summation of RJ times PJ, right? So return on the investment item J times probability for that J, right? So, well, I think it's best to use an example here. This is a table 8.2 from your textbook, okay? So we're talking about two different stocks, Duke Energy versus TI, Texas Instruments, okay? And this is just a hypothetical scenario. We think about three different states of the economy: recession, normal year, boom year. Okay? So if the economy happens to be a recession, for somehow, somebody came up with this probability, right? What's the probability for an economy to go into a recession? 0.2. Probability that you will have a normal year is 0.6, or 60% of the times you can expect normal year. And the rest, 20% of the times, you can expect boom year. So maybe this is based on historical data, right? So out of last 10 years or 20 years, maybe 20% of the times it was a recession, 60% of the times it's normal, and so on, right? So we have probability for each state. So this column is Pj, P1, P2, P3, right? And of course, summation of all probabilities must be equal to 1, okay? Because we should have exhaustive coverage of all the states, okay? Or possible states of the economy. Okay? And then, I guess maybe you, again, use the historical data to come up with this return percentage. In case economy goes into a recession, the Duke Energy stocks tends to return 10% on the investment. If the economy is slightly better as a normal year, then you can expect 18%, right? If economy is really strong in a boom year, you can expect 26% return. Okay? On the other hand, TI, Texas Instruments stocks, you can actually expect negative return if the economy goes into a recession, which is typical when you're dealing with technical stocks. Duke Energy is a utility company, right? And utility company, they sell electricity basically, right? So whether the economy is in a recession or boom, people have to use, or companies have to use electricity, right? So there may be some fluctuation, but not drastic fluctuation, right? But in the case of technical stocks, you tend to see a lot larger fluctuations depending on the states of the economy, right? So, for example, if the economy goes into a boom, then TI, you can expect even 40% return, right, from TI stocks, okay? So that's the idea, yeah? So we have PJs here and RJs for each stock here, right? So how do you calculate the expected return? Well, you multiply RJ times PJ and add them up, okay? So on average, that you can calculate, you can expect 18% return from Duke stock, okay? And on average, you can expect another 18%. So I have a feeling that they, adjusted these numbers slightly so that you will have 18% average return or expected return in both stocks. Okay? The point here is you can have drastically different fluctuation in returns, and yet you can still have the same return, expected return from two different investments. Okay? So that's how you calculate expected return. How about standard deviation? Well, that's what we typically do in statistics. In statistics, if you want to understand any random variable, okay, we use this notation. Okay. What that means, a random variable x is distributed normally with a mean value of mu and standard deviation of sigma. Okay? So if you know the mean and standard deviation, then you can say you pretty much understand the behavior of certain normal variable, certain random variable. Okay? So, well, in terms of stock returns, we just used R hat to replace the mean value or expected value of stock or return, stock return. Okay. So what about the variability? We know what you can expect typically. So in statistical term, you can say this is a central location or average. Okay. But that's not enough because as you see here in this example, the Duke stock and TI stock, they both returned 18% for average return. But as you can see, their variability is quite different. Okay? You see a lot more variability in the returns of TI stock than in Duke stock. Okay? All right, so how do you calculate the standard deviation? We use this formula, square root of summation Rj, right? Rj minus R hat square times Pj. If you remember your basic statistics, what's the typical formula for standard deviation, if you still remember? Right? That's summation of xi minus x bar square over n, right? That's the typical equation for standard deviation. And if you compare this formula and this formula, you will see very close relationship, okay? But they basically are identical formula, okay? Because this is the sample size, okay? So if you have, in extreme case, in your sample, you have just 2 observations in your sample or in your population, right? Then that's going to be divided by 2. Xi, any particular x value minus mean value. So deviation squared summation divided by n, right? Well, suppose you have only 2 possible states, okay? Boom or bust, okay? And they are equally likely, okay? Then probability for each would be 1/2, right? So in other words, that's going to be exactly divided by 2. Okay? And you see they are exactly the same formula. Okay? All right? So we are talking about exactly the same concept of standard deviation as we learned in statistics. Okay? So here's more practical example of how we calculate the standard deviation. Again, we have Duke stock for 3 different possible states, 3 different possible returns. And here we have expected return. So Rj minus R hat is -8 here, +8 here, 0 in the center, right? So you could square the deviation, right? Add them up. Well, before you add them up, you multiply the probability here, okay? And if you calculate it, you find the standard deviation. Well, actually, this is variance because this is before you take a square root, okay? So if you take a square root, the standard deviation comes out to be 5.06%, okay? If you remember from statistics, both variance and standard deviation measure the same thing, same concept, the variability of a random variable. Okay? The difference is variance doesn't have any unit because this distance is squared. So if this is a percentage, this is not a percentage. 25.6 is not a percentage because it's squared. Okay? So that's why we take a square root and return the value back to the original unit. So now you say 5.06 is a percentage. Standard deviation is percentage. If this was, say dollars instead of percentage, right? Then again, the variance doesn't have any unit because it's a squared value, right? So that's why we take a square root and calculate the standard deviation. And that, after you take the square root, that will have the same unit as the original unit. So if this was $1, this will be $1, okay? So that's the reason why we deal with the standard deviation. After calculating the variance, we do one more step of taking a square root, okay, to come up with the original unit, okay? Anyway, so we find out the standard deviation of Duke stock is 5.06%. Standard deviation of TI stock was 13.91%, almost 14%, right? So as we see in this variation, by just looking at the variation in the return values, right? The TI stock has a lot more variability, okay? And variability is what we mean by risk in finance, right? When we say risk in finance, we're simply talking about variability or uncertainty, okay? So you can say TI stock is a lot riskier than the Duke stock, okay, based on the standard deviation, okay? Graphically, this is the situation. We have Duke stock return variability or distribution of Duke stocks, right? And you can say, well, we found that both Duke and TI stocks returns are centered at 18%, right? So on average, you can expect 18% return from both Duke stocks and TI stock, okay? However, the variability is a lot larger in case of TI stock. So the distribution is a lot wider and flatter in the case of TI, okay? And that represents higher risk, okay, in terms of financial terminology. Okay? Is that okay so far? Okay. Yeah. Well, we actually don't know exactly what the shape of the distribution is for Duke stock and TI stock, right? But we just use assumption that they are, well, similar to normal distribution. The definition of normal distribution is, well, first of all, it has to be symmetric, right? And then it has to have bell shape. That means we have a higher mound or stack in the center compared to the end of the distribution, right? So in the center, we see a lot more observations compared to the margins of the distribution, right? So in both cases, both Duke and TI stock, we have symmetric and mound-shaped distribution, right? Well, in order to qualify normal distribution, there has to be more condition satisfied. Like within one standard deviation, you have to have 68% of distribution. Within 2 standard deviation, you see 95%. Within 3 standard deviation, almost 100%, 99.7%, right? So, we are not saying that Duke stocks and returns and TI stock returns are normally distributed, but we just use this shape of distribution, right? Well, there are certain conditions you can satisfy to be able to use normal distribution, right? Like central limit theorem. Typically, as long as you take a sample of 30 observations into your sample, right, then you can assume that the sampling distribution or the expected return is normally distributed, even if you have no idea what actual distribution is for the actual stock returns, okay? So assuming that, suppose we can assume that these returns are normally distributed, right? Then here we, according to the chapter, we can do one more thing here, right? As you see here, there's 18%, 10%, 2%, and 0% here. And they shaded to the area to the left of 0%, right? So what they are doing here is what is the probability that return on TI will be less than 0? In other words, if you are considering investing your money in TI stocks, okay, maybe you want to know, is there any chance that I can lose money in this investment? Okay, so based on this distribution, based on the mean and the standard deviation of the stock returns that we found out, right? We can find out that probability, right? So, well, that is, we can convert it into probability that Z will be less than 0 minus 18 over, what was the standard deviation? 13.91, is that right? 13.91, okay. 13.91, okay? Because Z-score is X minus mu over sigma, okay? Okay. So what we are doing here is, well, we're trying to convert this probability into the this probability that the z-score will be below this number, right? So that we can use z-table, right? Z-table so that we can come up with the actual probability, right? All right, so if you calculate that, what do you get? Negative 1.2? Just exactly 2? 2.9? Okay, 2.9, okay. All right. Yeah, once you do that, then we can use the z-table. I'm assuming that most of you took the first class of statistics. And this is a z-table, okay? And you will see the similar table in the back of your textbook. I believe it was table 5, something like that. Okay? Right after the time value of money table, there is a z-table. Okay? So here, as you see here, we have this light, what's the color? Turquoise color here? Okay, you can see the difference between this and this color. Okay? So the area to the left of z-score is given here in this table, right? So if you look at negative 1.29 here, negative 1.2, and go across to the column 9 here, 0.09 here. So the last column, that's the 0.0985, right? 0.0985, right? So we find out this is 0.0985, okay? All right, so what we're saying here is this blue shaded area here. Well, you know the total area under the curve is what? 1, right? That's because we're talking about probability distribution. And this is what we call probability density function, right? So the total area under the probability density function is always 1, right? And it happens, we just found out that this blue shaded area is 0.0985, right? So what is your conclusion? What does that mean? What's the story? If you invest your money in TI stocks? He was first. Okay, go ahead. Get what? Minus return. Okay, yeah, that's right. Okay. Yeah, so that's what that means is there is about 9.85% chance, right? 9.85% chance that you can actually lose money. Your return can be less than 0, right? If you invest in TI stocks. Again, assumption, you have to understand the assumption. You know, this conclusion is purely based on two numbers, the mean and standard deviation of TI stock returns, okay? We don't actually know the actual shape of the distribution, right? So assumption is assuming the return of TI stocks are normally distributed, or we can, assuming that we have satisfied certain conditions, that we can assume that the normal distribution, then you can expect this, right? Or almost 10%, right? Almost 10% of times you have to be ready to lose money, right? Is that 10%? I'm sorry, 1%, right? Almost 1% of time. Oh, hey. 0.09, 9.8%. Okay, so 10%. All right? So you can say, you know, this is, again, technical stuff. Okay? And you know, depending on the economy, you have to expect some variation. Okay? All right, before we go on, let's talk about one more thing about this variation or return and standard deviation. Okay? Standard deviation, you can say it is an absolute measure of variability. absolute measure of variability. Okay? Coefficient of variation, CV, is a relative measure of variation or variability, relative measure of variability. Okay? Coefficient of variation is simply standard deviation divided by standard expected return, right? In statistics, CV is sigma divided by x bar, right? Or either sigma divided by mu or S over x bar. Okay? In case you have population standard deviation and population mean, you can do that, right? But if you don't know the population mean and standard deviation, you can do the sample standard deviation divided by sample mean, right? That's the coefficient of variation, right? So we're talking about the variability in relation to or as compared to the mean, right? The center, right? So you can, I guess I can use an example here. Suppose you have two different stocks, A and B, and expected returns for two stocks are 5% and 12%. And sigma, standard deviation happens to be 3% and 6%. Okay? Then, if you just look at the sigma, which is the absolute measure of variability, you can say stock B is riskier because there is a higher variability in return, right? But when you calculate, CV, I mean, in our textbook, they just use V for coefficient of variation, right? That's what? 3 over 5, which is 0.6 or 60%, okay? And this is 6 over 12, which is 0.5 or 50%. Is that right? Okay. So compared to the return, the amount of risk is only 50% in the case of stock B, right? But when you compare to the return, right, the 3% risk in it, 3% standard deviation becomes 60% variability, right, compared to the return, right? So when you think about, this is useful when you compare the two different investments of different expected returns. I think I changed this just now. In your notes, it probably says projects of different size, right? So strike the size and change it to expected returns, okay? So when you compare investment projects with different expected returns, then coefficient of variation is quite useful as a measure of relative riskiness or relative variability as opposed to absolute variability. Okay? Okay. Another concept of the risk is it depends on time horizon. Okay? This is the case of Radio Shack, which is an electronic components store. I don't know whether it's real or hypothesized. Probably a little bit of changes to make the illustration, right? But the idea is this here, right? On this horizontal axis, you have net cash flows in $1 million, okay, from a project. I guess it's one of the projects they analyzed within the company, Radio Shack company, okay? And they found out that in the first year, let's say, this axis measures time in year, right? So first year up to 7th year, right here. And what they're saying is, okay, if you start the project today, which is time period 0, right? Then over next year, you can expect about $2 million return, right? Net cash flow, right? But there are some uncertainties depending on the, I guess, the market condition. You can make a little more than 2 million or a little less than 2 million, right? So we have this distribution of possible cash flow amounts. Okay? You understand? Okay. But in the second year, the assumption is, I guess, somehow they found out that expected net cash flow remains the same over the next 7 years, okay? But variability increases, okay? So uncertainty increases over the years. Why? What makes it true? Time. What do you mean by time? Right, yeah. So if you are talking about just 12 months later, you can use your given information and the best known theory or whatever, right, to make some assumptions and come up with the expected cash flows, right, the maximum and minimum cash flows, okay. But as the time horizon increases, 2 years, 3 years, 4 years, right, then uncertainty increases because basically anything can happen, right? Anything can happen next 3 years later, 5 years later, 7 years later, right? So you cannot be certain as you would be for the just next 6 months or 12 months later, okay? So that's the simple nature of the relationship between the riskiness or variability of investment and the time, okay? What kind of things can you expect over the years, over many years? Well, you can think about natural disaster. Natural disasters like earthquake, flood, tsunami, hurricane, If you think about last 5 years, just 5 years, all those things have happened, right, over the world, right? How about political uprising? Basically war or civil war or conflict or terrorism or all kinds of things, right? You know how much devastating effect the 9/11 had to the U.S. economy and to the entire world economy, okay? And then, economic and financial events, okay? Just 4 years ago, right, there was a financial crisis. Was it 4 years ago? Yeah, 4 to 5 years ago, right? And the Wall Street crumbled. Okay? So all kinds of things can happen over time. Okay? That's a good example. Is 2010. There was a BP oil spill. BP oil spill, right? So, do you remember this? Does anybody remember this? 2010 BP oil spill. There's Gulf of Mexico, south of Louisiana, right? And the Gulf between the Louisiana. Okay, here's the Louisiana. Here's Florida, and this area is called the Gulf of Mexico, right? Okay. Just take it as it is, right? Believe me, the U.S. looks like this. Okay, so BP is a British Petroleum, right? One of the biggest oil companies in the world. Okay, and they were extracting oil from Gulf of Mexico. They have lots of holes, lots of wells, okay, in the Gulf of Mexico. In one of those wells, the oil rig exploded. You know, oil rig. Okay, there's in the ocean. This is the water surface. This is bottom of the ocean. So here's oil reserve, right? So in order to drill the oil well and pump the oil, you have to connect the pipe, right? And here's the oil rig. It's a floating station, right? Huge floating station, right? And there was a fire, an explosion in the rig, right? And it blew up and sank, right? And this pipe broke, okay? And there was a safety device. You know, it's quite similar to what has happened in South Korea about a month ago, right? There was a safety device, right? So in case this happens, it was supposed to cap the well automatically, so that the oil will not blow out from the hole, right? But that safety device failed, right? And this is a deep sea, very deep. I forgot how deep the ocean was, right? It took about 3 months for BP to actually finally cap the oil well, right? So a lot of oil seeped out of the well and into the ocean. The environmental damage was devastating. Okay? And because of this, BP stock price went down from $60 to $28 during these 3 months. Okay? And of course, this is something that you could have expected. You know, it's bound to happen sometime. But they had the safety device. You didn't expect the safety device to fail, okay? And it can happen, right? I know a person. I knew him about 25 years, okay? And when I met him in Kentucky, and he was working for OCW-HYU. OCW-HYU is the Standard Oil of Ohio. That's the company, huge oil company, right? That was about, I would say, 1985. I'm sure, way before you guys were born, right? So around a few years later, OCW-HYU was acquired by BP. Okay? So this person was acquired by BP, and he was quite a high executive, right? He's a Korean guy, okay? And he started working for BP. Okay? And then I would say about 7 or 8 years later, around 1995, he came to Korea as the president of BP Korea. That's the first time I think BP came to Korea. Okay? So after that, I visited him, just a short visit of the South Korea. I met him. Okay? I visited his house. And his house was on Songbuk-dong, right? And this house was rented by the company, BP Korea. Okay? It's a 3-story house. And I went into the house. There's a huge staircase in the middle, right? And there's an opening on both sides of the stairwell, so you can look up or down from the first floor to third floor. Okay? And both sides of both walls on the side were aquarium, huge fish tank. Okay? A lot of exotic fish, or you could see them on the walls, okay? From the first floor to third floor. And at that time, he told me that the BP Korea was paying 8,000 만 원, 8천만 원 per month. Monthly rent of the house was 8천만 원, 8,000 만 원. And the dining room was on the third floor. If you go to the dining room, you could see the entire nightscape of Seoul. You know, Seoul is beautiful when you look at it at night. Okay? Anyway, so 2 years ago, I was hired by Hanyang University and came back to Korea in September of 2012. And I met him again. We had dinner, okay? And he told me the story. Okay? He retired from BP about 10 years ago, so about 2005 maybe, right? But he still had a lot of his retirement fund in BP stocks, unfortunately, right? In 2010, right? So during these 3 months, he lost $1.6 million, okay? Which is about, what, 17억, 17억, 18억, right? Yeah, just because of this. Right? He could have given me some little bit of the money, right? All right. So that's the relationship between time and risk. Risk increases because you just don't know what's going to happen in the future if you give it enough time. Okay? Okay. Here we're getting a little bit of technical stuff about the premium, risk premium. Okay? Required return that people require for, you know, the risky project has a few different components, okay? But basically you can separate between risk-free return plus risk premium. Well, of course, there are different risk premiums, different types of risk premium, okay? So you can say risk-free rate of return, what we see here, the first component, that one actually has two different components, right? First one is real rate of return. The second one is expected inflation premium. Okay? So for future, I guess I can give you this equation. In the later part of the chapter, you will see. Okay? RK is equal to R real plus R high E plus RP. What that means is the required rate of return, RK is required rate of return, okay, is the real interest rate or real return that people expect when they invest their money, right? And this real return is the amount of return that investors want if there is no possibility of default and no possibility of pi. What is pi? Inflation, right? Okay. In economics, we use pi for inflation. Okay. So this is the amount of return people expect or require if there is no possibility of default. If default meaning a company going down and foregoing their obligation for interest payments or return of the principal. Okay. Or if you can be certain that there will be no inflation, right? Then maybe let's say 3%. Okay? In the absence of possibility of default or inflation, investors may require 3%, right? But since there is typically inflation, expected inflation, people add a little bit to that, right? Because when there is inflation, you lose money, right? Suppose you received a 10% return on your investment last year, but if there was a 5% inflation, right? Then inflation simply means the purchasing power of your money goes down, right? You can buy less real goods and services from inflation, okay? So that's why people would require a little bit extra if there is inflation, right? And then other risk premium, right? If you can consider other risk premium, you can add that, right? All right, so what are the different types of risk premium? We can think about 4 different types of premium, risk premium: maturity, default, seniority, marketability. Okay? And let's see. Let's talk about the maturity premium first. Trying to think how we can make this a little bit less boring. All right. Let's talk about these 2 graphs first, 2 lines of graphs first. Okay? Has to do with the maturity premium. Okay? But the exact name of this curve, this green curve here, is called the yield curve. Or, in other words, term structure of interest rate. Right? The same thing. Yield curve or term structure of interest rates. Right? And in this case, we're specifically dealing with U.S. Treasury securities, Treasury bonds. Okay? So what that curve is about is on the horizontal axis, we have time to maturity. And on the vertical axis, we have yield to maturity, Y to M. You know how to calculate Y to M and with bond, right? All right. So if the maturity is very short, like 3 months, 6 months, a year, and so on, right? Then typically the yield to maturity is pretty low, right? Maybe less than 1% if you hold. I mean, you understand that 3 months Treasury bill doesn't even pay interest. It doesn't make any interest payment, right? Why do you buy then 3 months Treasury bill? Huh?
For a short period of money through selling.
Yeah, but what I'm asking is the 3 months, if you buy 3 months Treasury bill, there is no interest payment, right? Does that mean you don't earn any return on that Treasury bill? What did you say? Somebody said something. How does the Treasury pay interest on 3 months bill? Discount, yes, right. They're selling the bill at discounted value, right? So if it's a $1,000 bill, they sell it at, say, $900, $950, right? So if you hold it for 3 months, you pay $950 and hold it for 3 months, you get paid $1,000, right? So that's the interest payment, right? It's instead of actual interest payment, right? All right, and so on. So the short-term, as we know, the short-term securities have low interest rate. But if you buy 5-year bond or 10-year notes or 15, 20-year bonds, then the yield goes up, right? So this is what we call yield curve. It's just a connection of all those the dots that represent the maturity and interest rate, right? And this is the normal shape, which is upward sloping, which means the higher term, higher maturity bonds pay higher interest rate, right? Sometimes, though, we have inverse curve, inverse yield curve, just like this, okay? And you notice that this says August 1981. That happened about, what, 35, 34 years ago. Okay? So sometimes you can actually observe the inverse or downward sloping yield curve instead of normal upward sloping yield curve, right? What happens? What happened at that time? What? Huh? Stagflation, yeah, right. Or basically until most of the 1970s, until the 1981, right? The interest rate was really high. Market interest rate was very high. I think I told you once, right? My department chairman who bought the house, his house, he had to pay about 15% interest rate, right? And when I bought my first house, I paid about 6%, right? So during the 70s, the interest rate was really high, right? So what the market was saying is, this high interest rate couldn't continue in the future. So in the future, 5 years later, 10 years later, 20 years later, right? The market actually expected the interest rate to go down, right? That's why they paid low interest on longer-term bond rather than shorter-term bond. Okay, so that's the explanation for this inverse yield curve. Okay? But more general explanation for yield curve or maturity premium is this. Where they have three different theories. First explanation, or first theory, is expectation theory. Okay? And what that says is different maturity is associated with different interest risk. Associated with different interest risk. And so what it's saying is people expect, as you see in this graph, right? If people expect the interest to rise in the future, you will see the upward sloping yield curve. If people expect interest rates to be lower in the future, 10 years later, 20 years later, then you will see the lower interest rate for the longer maturity, right? So that's the idea of expectation theory. Okay? All right. Another way to put it is long-term interest rate. Interest rates are determined by expected future short-term interest rate. Expected future short-term interest rate. Okay? So once again, you can use this graph to explain that. Okay? So if 5 years later, let's say people expect the interest rate to be 16%, right? Then that's what people expect to be received, to be paid by this investment with the 5-year maturity. If 10 years later, 20 years later, if people expect a little bit lower interest rate for the short term, 20 years later, then that's what people are going to expect in the investment with the 20-year maturity. So long-term interest rate. For example, let's say this is, I don't know, maybe 14%, right? The fact that people expected 14% interest with the 20-year maturity security means that people expected that the short-term interest rate, let's say 1-year interest rate, to be 14% 20 years later from now, right? That's what this means, right? Long-term interest rates are determined by expected future short-term interest rates, okay? And that's the first theory. So basically, people's expectation determines the maturity premium, okay? The second theory, second explanation, liquidity premium. Liquidity premium means that the interest rate risk which means variability interest risk associated with short-term security is less than that for long-term security. For the long-term security. If you can't read it, let me know. I'll be happy to read it for you. Right? Interest rate risk associated with short-term security is less than that for the long-term security. And that's what we spent a lot of time to talk about here, right? In this graph. The risk associated with the short-term is a lot less. I mean, this variability is narrower in the short-term compared to the long-term, right? So the risk premium should be lower in the short-term securities compared to the long-term securities. That's a good explanation for this upward sloping yield curve. Okay? That's why the 20-year bond would pay higher interest compared to the 5-year bond. Okay? Then final explanation, market segmentation theory, is quite different. It simply says supply and demand for different terms different term securities in each segment, or let's say determine the return in each segment. Let me read it. Supply and demand for different term securities determine the risk, determine the return in each segment, right? So what that is saying is we have different segments. We have different market, basically. Short-term security market versus long-term security market, right? And we have demand and supply. Okay? And here's the return. Okay? So if for some reason demand is higher for short-term security, then the return will go up, right? No. Just think about it. That shouldn't be, right? Because it will raise the price. What do you think, right? If price goes up, what happens to the return? It will go down, right? If you have to pay higher price when you purchase the stock, then the return, relative return will go down, right? So, yeah. If supply for some reason is high for the long-term security, right, then the price goes down, right? And that will increase the return on the long-term security, okay? So market segmentation theory means, in explaining this, the term structure of interest rate, right? What happens was, here's a different market for short-term and medium-term and long-term securities, right? And all these returns are based on supply and demand, okay? That's the idea of market segmentation theory, okay? And this is just the explanation for maturity risk premium. Yeah? So we covered just one. The rest are pretty simple. Okay? Default risk premium. You know what default is? Here. Default risk means there's a risk that company has some financial problem, okay, and they won't be able to meet their financial obligation. That's what we mean by default, right? And more specifically, we can think about two different types of risk: business risk versus financial risk, right? And business risk has to do with the operating earnings, okay? So economy goes down, sales goes down, and the company cannot make enough revenue, right? That's the case of business risk, right? Or something happens, a company can be involved in a lawsuit, huge lawsuit, okay? Or there's a big accident like BP, right? Then that's a business risk, okay? Financial risk comes from their debt, basically, right? So company's earnings per share that results from the use of fixed cost sources of fund. What is a fixed cost sources of fund? Something like bond, right? It's a fixed cost, right? So when the company issues the bond, right, they have to pay interest, right? And depending on the interest liability, how heavy the liability can be, right? Then that can come with the as a financial risk, right? Basically, debt servicing cost, right? Debt servicing cost can cause the financial risk. Okay, so that's the idea of default risk premium. So if you compare to the corporate bond and the treasury bond, okay, both corporate bond and treasury bond will have maturity risk. Make sure you understand that, right? As you see here, even the treasury bonds, treasury securities they will have to pay higher interest over the longer term maturity security, right? So there will be no difference in maturity premium between the treasury bond and corporate bond, okay? But default risk will be a lot higher in the corporate bond, over the treasury bond, right? Treasury is, we're talking about U.S. Treasury or national bank, right? Like Bank of Korea, right? And when Bank of Korea issued their bond, right? National bond, right? Then we assume that the default risk is very low as opposed to the bond issued by LG or Tucson or whatever, Samsung, right? Okay. Seniority risk. Okay, here is another graph. Okay, we're talking about seniority, different seniority across different securities. Okay, so on the horizontal axis we have risk here, and on the vertical axis expected return. Okay, if you think about U.S. Treasury bills, which is a very short-term U.S. government security, then risk is very low. But at the same time, return is very low, right? But if you move along the ladder here, the U.S. long-term treasury bond and high-quality corporate bond, high-quality preferred stock. So the story is corporate bonds are less risky than the preferred stock, okay? But at the same time, that the corporate bonds pay lower interest, lower return on compared to the preferred stock, right? And then as we go on the higher level of risk, there is a junk bond, high quality common stock, and speculative common stocks, right? Very risky investment, right? So as you move along this line, the risk increases, but the required rate of return also increases. Okay? So we're talking about seniority risk premium. Which one is, well, in financial terms, this one has seniority over this one. Okay? For example, if you hold common stock of IBM and corporate bonds of IBM, then corporate bond has definite seniority over common stock. So in case something goes wrong, and IBM has to liquidate, okay, then the bondholders have first right to the asset compared to the common stockholders. Okay. All right, one last thing. Marketability risk premium. We're talking about whether you can sell if you're holding certain stocks, right? Let's say neighbor stocks versus what's some unknown company XYZ. Oh, yeah. In Korean market, neighbor stock is pretty well traded, right? So it's probably, in case you need to get rid of or liquidate your stock, it's probably easier, a lot easier to sell it, as opposed to XYZ company, which is, say, very unknown private company, right? So if you're holding some unknown stock, you got some marketability risk, okay? All right, I think that's it for today, and we're going to continue on Tuesday.